There are three big problems with measuring performance versus a plan. The first one, I think everybody's familiar with. It's sandbagging, which is the term used to describe people that understate what they think is going to happen so they get an easier target. And unfortunately, when you plan for mediocrity, you often get what you plan for. The second problem is target negotiations. And that negotiation has a lot of problems, one of which is it stifles the information flow. The business unit doesn't want to share everything they know with corporate because they'll wind up with higher targets and lower pay. And then the third one is the year-end push. Sometimes people, for example, pull January sales and profits into December in order to meet an objective. And they'll do so by offering discounts they wouldn't have had to offer. So overall, you're making less money because of the plan. So the first solution to all of this is to use a better measure. And the better financial measure is some form of economic profit. Economic profit refers to the difference between total revenue and total cost, which sounds pretty basic. But that total cost includes the expected return of the investors. And that has really important implications for the measure. Whereas accounting profit is only charged for explicit costs like interest, economic profit is charged for a full cost of capital. The total shareholder return, or TSR, of the companies using economic profit in their incentive plans outperform their peers by almost 5% a year and outperform the overall market by 7% a year. That's pretty outstanding results. I mean, some of these companies have been using this for more than 10 or 20 years. To have that kind of annual outperformance on average is really, really quite outstanding. We created a measure called Residual Cash Earnings about 15 years ago. And the measure is an economic profit measure, but it's cash-based because we capitalize R&D and we capitalize leases. We're taking rent out. And those help improve the quality of the measure. The lease adjustment's not that important anymore. A lot of the accounting changes in recent years have, for most companies, reduced the need for that investment. And R&D, we only adjust that when it's material and actually really changes the results. But you can imagine for a tech company, or like a life sciences company, it's a really important thing to treat their R&D as an investment in the business. When we charge the capital charge, the gross assets don't only include the capitalized R&D and the net assets, as you would see in EVA, but we add back the accumulated depreciation. RCE is such a complete measure with such a strong relationship to TSR that up is good and down is bad. You can't say that with any other measure, but pretty much no matter what you do, when RCE goes up, value has been created. When it goes down, value has been destroyed.